in Chapter 6, Capital Investment Appraisal. So within this chapter of Capital Appraisal, that means capital budgeting, accounting rate of return, payback period, discounted payback period, net present value, and IRR, capital rationing, capital budgeting under uncertainty, leisure buy decision, etc. Are the topics of the chapter of thing, and within the chapter we'll discuss phase by phase, because we have to discuss this chapter within I think 1 or 2 class, otherwise it will not be possible. So today within this chapter 6, capital investment appraisal, we are going to discuss accounting rate of return, payback period, discounted payback period, and later on we will also discuss, today we will complete net present value, and other things we will take another class. Capital investor appraisal, we will discuss capital budgeting, investment conceptual framework, capital budgeting process, and some technique, discounting, non-discounting techniques, investment appraisal, capital budgeting decision criteria, accounting rate of return, payback period, discounted payback period, etc. We know the investment is a key part of the fixed asset. Sometimes that means buildings of the business, machine of the business, any big process of the business, and net assets such as machinery can boost productivity, cut cost, and give a competitive edge, etc. And is the we are investing here. And capital investment appraisal, also known the capital budgeting, is primarily a planning process which facilitates the determination of the concerned firms, that means company's investment, both long-term and short-term. And a company may decide to invest in a long-term project if for the future is likely to be achieved. And financial managers, as a financial manager, we will make the estimation, projection, and the techniques of identify whether the investment is appropriate or not. And this is known as investment appraisal. The capital budgeting, what is capital budgeting? Capital budgeting is a process, that is business, used to determine which proceed fixed asset purchase should be accepted. And this process is used to create a quantitative view and each proposal fixed asset investment, and they are given national basis of making judgment. So we know the importance of capital budgeting. They're very much important, capital budgeting, because ultimate goal is maximize the wealth of the organization. So it's a long-term goal and involvement of a large amount of funds, monitor and control expense, transfer of information, difficult to investment decision, and taking a good decision that make the wealth of the organization, that maximize the wealth. That is the importance of, very much importance of capital budgeting. Here, investment appraisal is a key area in most business, we know, and decision concerning capital expenditure, coupled with strategic planning, marketing, organizational decision are frequently critical in determining the future success of the business. And this document advise managers on how they can contribute effectively and efficiently to decision making and control during the process of investment appraisal. So that means investment appraisal principle and capital. Well, if we go for capital market on the other side, so at this there are some internal factor and there are some external factor. Internal factor means accounting practices, capital investment policy, agency cost, corporate financial responsibility rates, and that is the internal factor of the organization. And external, that means if you go for investing capital market, that capital market control or debt or equity ratio is a factor, and regulatory requirement or regulatory environment. And we know that regulator of capital market is Securities Exchange Commission, and also for the banks who are also listed, but it's also the regulator of Bangladesh Bank. and also if any government entity, the regulator of the governments, so that means accounting standard risks, etc., the external factor, a new integration network added with that, and that add value within the organization. So capital budgeting process, if we see, there are 4 or 5 process shortly, and that firstly identify investment opportunity where we will be able to invest money, and 2, evaluate all investment proposal. How there are a lot of proposal we can get, then from there we will find the proposal and analysis. So here choosing the most profitable investment. So before choosing, we have to analyze and we have to determine which project we have to take, because based on the different types of technique, we know the different types of techniques, that means NPV, IRR, PI, that means profitability index, modified IRR, payback period, discounted payback period, etc. as the technique of capital budgeting. So choosing the most profitable investment, and then capital budgeting and apportionment, that means how much money will allocate for the project, and then performance review. It is the capital budgeting process. So the capital budgeting process is the process of planning which is used to evaluate the potential investments or expenditure, well, basically that is fixed expense whose amount is significant. This process is decision regarding the source of finance and then calculating the return that can be earned from the investment done. Capital investment appraisal technique, there are, if we know, the investment appraisal is measure whether the benefit of a project exceed the cost of the investment. Various investment appraisal techniques are available, namely discounted and non-discounted cash flow. So non-discounted and discounted. That's why non-discounted techniques are not considering the time value of money. That means non-discounting cash flow do not consider the time value of money. That means inflation. But the useful techniques for the analysis of the project. But discounted cash flow takes into account time value of money, and therefore is the more accurate measure of appraisal. If we see left side, traditional or unsophisticated, that means accounting rate of return or average rate of return method, that traditional, also payback period, we know. And if we see right side, that means time adjusted, it is sophisticated, discounted cash flow technique. That is the number one is net present value method. We are using it, and internal rate of return, that is IRR. Also profitability index, sometimes terminal value. Also we are using sometimes payback period, discounted payback period. Payback period is traditional, but also discounted, also traditional, but is considered the time value of money. The capital investment appraisal, we see there are different types of technique: net present value, accounting rate of return, internal rate of return, modified internal rate of return, adjusted present value, profitability index, equivalent annuity, payback period, discounted payback period, real option analysis, a lot of techniques. So basically we are using mostly net present value and internal rate of return, payback, accounting rate of return. Sometimes we are using also profitability index also. When appraisal, look here, before any investment decision made, we have to consider what would be the initial investigation, that means feasibility study of the project and project screening, and this within this stage we are calculating the different types of technique and project screening there, and analyze and acceptance. After analyzing, then accept which project we will take, and then continue monitoring is the another part for the project. If we take the proper or good surveillance or monitor, then project would be viable and project that means it would be able to complete the project. And so capital budgeting decision criteria, how we that means there are the decision rules should consider all relevant cash flow. So basically, which technique is the best technique? We can say that technique, that means they consider all cash flow, relevant cash flow, and the decision rule should acknowledge the time value of money at concept. That means also have to think that time value of money and consider the time value of money, and the decision rule should consider the riskiness of the cash flow, and the decision rule should always rank project, that means rank number 1, number 2, etc. So they should project that added the most to the value of the firm are ranked highest. The one of the technique, accounting rate of return, we are going to discuss this one. So it's called the ARR. Sometimes it's called the average rate of return also. The same is a totally accounting is not with the related with the cash flow, but it's related with the profit, accounting profit. So ARR stands for accounting rate of return, is the calculated by dividing the expected income from investment and cost of that investment, and the return of capital employed express the investment return as a percentage. This technique takes into account the amount of capital investment necessary to back up the project. If we note that it uses profit rather than cash flow. So it's use profit rather than cash flow. That means only use the profit. But all other techniques are using the cash flow. But only ARR using the profit. ARR we can calculate this way. Accounting rate of return, average income divided by average investment. So also we can say these different types of formulas here. Also another two, that means average income after tax, average investment, or average income after tax divided by original investment plus salvage value divided by 2. It's been the average investment. What is the advantage of this technique? This technique has huge advantage. That means it is very simple. Anyone can understand it. Readily calculated using the accounting data. It uses the entire stream of income in calculating the accounting data. That means they are using the, for example, if project life is 5 years, the 5 years profit, expected profit, they are using here. Not proportion as like payback period, but payback period using the cash flow. Here is accounting profit, and limitation is that it is used accounting profit, not cash flow. In appraise that project, it is not the true rate of return, and it is ignore the time value of money. Basic problem is ignore the time value of money. Profit occurring the difference period are valued equally. For example, today's 1 taka is not the same of tomorrow's 1 taka. But here, considering all are the same, it does not consider the length of the project life. It does not allow the fact that the profit can be reinvested, as we have seen in internal rate of return. The profit, that which profit we get, that can be reinvested, and that's why IRR calculated that way. So it is the limitation. So computation method, we know that first we have to estimate net income and estimate the book value, average net income, then we do that way. Sometimes it's called also average rate of return. So average rate of return is that it is the average project earning after tax and depreciation divided by the average book value of the investment during its life. Accounting rate of return, also known as the average rate of return. So we can say that ARR, also called the accounting rate of return, as well as average rate of return. ARR is the financial ratio used in capital budgeting. The ratio does not make into account the concept of time value of money. ARR calculate the return generated from the net income of the proposed capital budget, and ARR is a percentage return. And what would be the decision? Which item will be taken? That means when ARR is greater than required rate of return, then the project should be accepted. And when ARR is less than the required rate of return, the project, we will not take the project. So here we can calculate in a different way. This way, accounting rate of return, average annual operating income for the asset divided by initial investment. Also 2 or 3 formula we can use. Also alternatively, we can use this way also. A measure of the profitability that measure the effect of an investment of a company's accrual basis income, not net cash flow. So average annual operating income from asset divided by average amount investment in asset. And that also we can say number 2, average annual net cash inflow minus annual depreciation expense divided by average amount investment in asset. If we not get the data of profit. And also 3, total net inflow of the asset minus total depreciation of asset divided by 2, that divided by useful life, and also divided by amount of the investment in asset plus residual value divided by 2. So this also can be calculated. ARR, very simple. And here if we see different types of accounting rate of return math, just we will discuss 1 or 2. One of the company, which is truck, a new wheel loader can be purchased directly from 3M company, cost of $150,000. The new lorry annual cost is $25,500. An increased annual operation expense 4,500. That means this cost is increased after purchasing that. The useful life of the loader is 20 years. After 20 years, we will have a salvage value 30,000. Company uses straight line method of depreciation for all assets. Compute the accounting rate of return. First of all, we have to calculate in different stages. Number 1, computing the depreciation first. If we compute with the depreciation, look here, annual depreciation, cost of that asset minus salvage value divided by life. We know it. So here come 6,000 is the depreciation per year. And computation the annual net cost saving. How much cost save? Because annual net cost saving calculating this way, that means earning there would be 25,500. Here cost increase there on 4,500. Also depreciation have to charge 6,000. So actual net cost saving is 15,000. So computation of average investment in asset. So here calculating the average investment, cost of the asset plus residual value divided by 2. So average investment is here 90,000 as part the formula given this method. And number 4, the final computation of the accounting rate of return. So annual net cost saving divided by average investment multiplied by 100, then we will get 16.67%. So is the ARR is if is anything is saying here, if said the expected rate of return 15%, then that is acceptable because is a more than 15%. So now payback is the number of years is required to recover the original cost, which is investment in a project. So the payback period is the time a project will take payback money spent on it. It is based on the expected cash flow and provides the measure of liquidity. The payback period refers to the amount of the time it takes to recover the cost of an investment. Simply put, the payback period in the length of the time an investment reaches a break-even point. So if you see the formula, it is the payback period, initial investment divided by annual cash inflow. It is the different types of formula. If we see here, look here, here's just simple one, an example only. An expenditure of 2 million is expected to generate a net cash inflow 5 lakh each year for the next 7 years, which we are investing here, divided by how much money, and then we will get 4 years. So 4 years, this 2 million will come back. And it is the even, that means all amount is even. When it's uneven, different cash flow, not is the same. So that time we have to calculate this way. For example, in the year cash flow and the cumulative cash flow. So from here we have to calculate the real payback period. So here some advantage of this formula, of this technique, that means it is simple also. It is useful to certain situation. Rapidly changing technology, it is very much important, because technology side, today's technology and tomorrow's technology, they're not same, and day by day technology is changing and huge changing. So that type of counting is appropriate for rapid changing technology and improving investment condition. It favors quick return, that is how much money we are investing, that how fast we'll get the money. So help company grow, the economic risks, maximum liquidity. Also it is the use the cash flow, not accounting profit as like accounting rate of return, but it is using cash flow. So it is the positive side. But we have the negative side also. It ignores return after the payback period. For example, what we have seen here, 4 years payback period. So, but is the life is 7 years. So we have another cash generating year also, but not considering that one. So here, this is ignore the return after the payback period, and it ignore the times of cash flow. This can be resolved using the discounting payback period. That's all, discounting payback period. It is a subject to gives no definition investment single and ignore project profitability. It's ignore project profitability. It is these advantages of payback period. So here we have seen few payback period question. Also solution is here. For example, here investment is 2 times, cash outflow 2 times, inflow within the 8 years, it is the inflow. So all have to consider here. Look here, this way is the calculation is here, is the beginning and the investment also, cash inflow and the cumulative, and when payback periods come, the calculating here. So this way we can also calculate within our Excel sheet. So giving this way, payback period we can calculate, very much easy and simple. And this one, few math is here. Here are criteria, and if you see the discounted payback period, as same as payback period, but is discounted through the discounting factor. This discount payback period is a capital budgeting procedure used to determine the profitability of the project. A discounted payback period gives the number of years it takes to back even from undertaking the initial expenditure by discounting future cash flow and recognize the time value of money. So what is the main theme is that is to recognize the time value of money which do not recognize in the payback period. So it has some advantage, and it is also advantages is it consider time value of money while calculating payback period. It determines the actual risks involved in the project, but disadvantages fail to determine whether the investment will increase the firm's value or not. Calculate for discontinued payback period can get complex if there is a multiple negative cash flow. So it is the disadvantages. So what is the difference between both payback period and discounted payback period? So by the definition, the difference is that payback period, the amount of time needed for the investment to break even. But discounted payback period, the amount of time needed for an investment to break even considering the time value of money. So it is the main difference, time value. Time value of money concept, payback period not included, but discounted payback period is included. Cash flow, payback period, forecast cash flow use, but discounted payback period, we are using discounted forecast cash flow. So it is the basic difference. Here, this discounted payback period is okay. So if we see an example, evaluate the economic benefit of a project taken from this website. Here is a link also. 1 to 5 years expected after tax operating cash flow. This sum is 70 million, 55 million, 40 million, 25 million, and in the 5 years 10 million. So initial investment is 150 million. And if we use the Excel, so here we come at this as in the page there. So just putting the year and expected cash flow, cumulative cash flow is here. So cumulative, from the cumulative cash flow, look here, investing is, as said, investing is 150 million. First year cash inflow 70 million, 55 million, third year 40 million, etc. So this figure is calculating here. Look here, expected cash flow in the year 0, 150 million is here. It is a minus, so cumulative minus. And the year first year, 70 million is inflow, and minusing this 17 inflow, cumulative is minus 80, because we also require, for payback side, we also require 80 million. And in the year 3, 40 million cash flow. So here another 25 millions after getting 2 or 3 years cash flow. In the year 3, 40 million, that time 15 million is positive. So payback period would be in the year 2, before that one. That means year 2 is the base and fraction is next year. So here, look here how calculated is cash flow in payback completion year. That means this year is completed and positive also. So here that figure 40 million, and cumulative cash flow for the year preceding payback completion. So payback completion is year 2, preceding in year 2, this 25 comes here. So after calculating, we will get payback period is 2.63. Also, if we go for Excel, so here is the formula how we can use it also. So now this with payback period, this payback period is comes the discounted payback period. How it's, there are few stages also. Discounted rate 8.50. So here in the year 1 to 5 years. So here discounting 8.5. This total figure is coming here. So from there, if we calculate the discounting cash flow, this one, and cumulative discounting, this one. So from here, we definitely we see that in the year 4, it is the positive. So from there, we calculating there. So here 7.4, that means point is 34. So discounted payback period 3.41, because here 3 is the base and 4 year completion is the 4. So 3.41 is the discounted payback period. So here it is the discounted payback period. So if it's thus we see is one math here. Here it can be a question, because 4 or 5 items here with the theory also. Look here, if we ignore the theory here, we can see the cost of machine 1,55,000 and its expected life is 5 years. The scrap value of the machine at the end of 5 years, 5,000. The expected profit from the machine are given below. Expected profit, that means 25,000, 45,000, 40,000, 20,000 in the year 5, 10,000. So we have to calculate the accounting rate of return. Look, just adding all profit divided by the year, number of year, 5 years, then average profit comes 28,000 and average investment. So what would be the average investment? 1,50,000 initial, and the salvage value come from the last year. So adding that divided by 2, then we'll get average investment is the 80,000 as per the formula ARR, and then we'll get 35% is the accounting rate of return. Also, it is the theory. What is the accounting rate of return? Describe the advantage and disadvantage ARR. Answer will be that. It is the non-discounted evaluation technique of capital budgeting, and very simple. The formula is that average annual profit after tax divided by average investment multiplied by 100, and the advantage is that it is easy. Anyone can do it, no complexity. And disadvantage is that not considering the time value of money, not considering that all cash flow, etc. is the disadvantage. Payback period is one single math. A project requires an initial investment of 40,000 and it is estimated to generate a cash flow of 5,000 per year for the year 10. That means equivalent amount 5,000. Wholly 10 years, every year will get 5,000, 5,000, 5,000 this way. So calculate the payback period. So it is cash flow is very much single one. So that's why it is very much easy to calculate. If we see here, look here, just 1 line or 2 line, your math is complete. So here, initial investment 40,000 divided by annual cash flow. So comes 8 years. So within 8 years, the money will come back. So answer is easy. But when this question is cash flow is not even, that would be that one. Look here. A project requires an initial investment of 5 lakh and is estimated to generate future cash flow 62,000, 70,000, 45,000, 72,000, 75,000, 85,000, 90,000, 56,000, 50,000 and 55,000. So we have to calculate the payback period. One of the technique of capital budgeting. See, it's all seems simple, but we have to calculate this way. Look here. So first, it is the 10 years item. Cash inflow, all inputting here, and cumulative cash inflow. Look here, 62 and 72, adding that one. And sometimes someone can do another way. They putting in the zero how much x outflow is here, but here not putting the outflow, only inflow cumulative, doing that in the year 10. Total inflow is 660, that means 6,60,000. So from here, how the payback period calculate? Look, so here in the initial investment is 5 lakh. Now 4,99,000 is received in 7 years. So look here, this 5 lakh where we can see there in the year 7, here 4,99,000 is recovered, and only remaining 1,000. So we can say that in the year 7 is the payback period, but have to add proportion of next year, few months also. So 7 is the base 7. Look here, payback period, this 7 is base 7, and in the 7, 1,000 remaining unrecovered. So this unrecovered remaining 1,000 have to divide the cash flow of next year's. That means which year is fulfilled, that 56,000. So 1,000 divided by 56,000 is come 0.02. So 7 years, 0.02. 7.02 years is the payback period. So it is the uneven cash flow. So here we have discussed 3 items: accounting rate of return, payback period, and discounted payback period. So here we have seen what is capital budgeting very shortly, and we have seen the investment appraisal, capital budgeting process, and also we have seen the non-discounted techniques, discounted techniques. Here is mentioning all things. So here we have seen there are different types of technique we have, and we are using majorly NPV, IRR, payback period, profitability index, etc. And also we have seen capital budgeting decision criteria, the initiatives, that means process also. And also we have seen the accounting rate of return and discussed with its limitation and advantages, and also when it's accept, and we just discussed few math here. And also we have discussed the payback period also. In the payback period, and we have seen advantage and disadvantage of payback period. Also we solve few math here, discuss it with that, and also we have discussed the discounted payback period and difference between discounted and non-discounted payback period and example. So it's all for this item. Now we are going for discuss net present value.